Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, with that said, here's some examples of things you can look for within hours of a major market peak. This is a Wall Street Journal article, October of '07. A major peak. Exercising the ghosts of October's past, despite housing slump crashes such as '87 remain are likely to stay memories. And of course, when you see a cover or a statement like that, it's not necessarily a reason to sell all your stocks if you're in a good bull market. But it's one to say, okay, well, there's a little too much complacency out there. People get a little too optimistic. And again, this cover, October 15th, you can look it up, is when the market peaked. So that's kind of telling. Fast forward a couple of years or a year and a half or so, the same day the market bottomed in the Wall Street Journal, the Dow 5,000, there's a case for it. March 9th, and again, the Dow was up above 6,000 at the time, so they were predicting a pretty good pullback in the face of what already had been pullback. But that's a lot of negativity out there when you see something like that. Doesn't mean the market's going to bottom, but it means, kind of like what we're seeing now. I see a lot of negativity, so I'm not saying, jump in with all your money because the price action's still weak, but it definitely, with all the negativity we're seeing now, there are some similarities with March 9. It's just we need the price action to firm up. And one last thing is it talks about strategists on this article, strategists rally. I'm a quote-unquote market strategist, and I can tell you there's been a lot of times when reporters start calling the market strategists, they're kind of at their last wit. They're at wit's end. The market's going down. Why is it going down? What's going on? So sure enough, they start calling market strategists. And I've actually used this. Bloomberg's quoted me numerous times. A lot of times, I finally caught on when they start calling me. Not that I'm necessarily that bad at what I do, but sometimes that's a warning sign. Okay, well, they're calling me. Maybe I give the quote and I give what everybody else is saying, but it's time to start worrying and not worrying. But look for the trend maybe to be over. And when you see a lot of strategists quoted on the upside or the downside, that could be a pretty good key. Fibonacci retracements, I definitely look at these. I don't know how many of you use them, but really interestingly, a 61.8% retracement is a very common retracement level. And as you can see here, from 82 to the peak in '07, the S&P was predicted to bottom at 666. Based on a 61.8% retracement. So through the day, you have this major retracement. And I remember when it happened that day, there was a lot of talk on floors and some emails going around. Okay, we just, and we had a big reversal that day. But, we just had a 61.8% retracement of a major bull market. And you can say what you want about Fibonacci retracements, but when you pull this one up, I think it kind of stands the test of time that maybe there is something there. Now I'm going to talk a little bit about what we're doing currently at Schaeffer's when it comes to trading ETFs. And these are things, Bernie's big on, you follow what everyone else is following to a degree. We also incorporate sentiment. But you take certain tactical indicators and maybe make a small tweak to them and kind of look at them differently. One thing we've definitely been doing and found some success with is on Google. You can find this other places, but on Google Finance, they've got this neat chart where you just type it in, your ticker versus the Dow Jones. And it gives you kind of what it's done year to date. Now you can see here's the Dow. Look at this chart. It's really interesting. Back when we had the Japanese crisis in March, the market bottomed virtually at the break-even line. And it makes sense. There's potentially a lot of reasons to think that's an area you can find some support. And then in early August, when we had all the budget issues and Europe really falling apart, we violated that. And it's kind of, okay, well, now we violated the previous low and we broke to negative for the year. That's maybe a warning sign. But look what it's done recently. It's gone up 0% a couple different times. And then, as we've had in this wild market, a violent pullback. So, numerous times we've gone to zero. We've actually kind of loaded up on some puts for some shorter-term trades. And fortunately, it's been correct. Now, will we eventually get back above 0%? Let's hope so. But, for the time being, this market continues to kind of trade between that 0 and negative 7% or so range, and we all know we're range bound, but this just kind of confirms it to us, and this is a neat way you can start trading ETFs also, is see where it is year to date, what's going on there. Because we've done some studies and we've looked at it, and I would have said 3 or 4 months ago, it sounds a little random, but I can tell you when you incorporate this with other things, there potentially is a little bit of an edge here. And here's the S&P 500. You can see it also to the penny most in March bottomed at zero, violated early August. Now the S&P, we've noticed been finding support around that -10, -11% area. So it's similar with the Dow, but this is a little more volatile. But definitely there's some support there. So if we violate the -10% or so, -11% return for the year, that would definitely be a big warning sign to us, and probably say that the bears continue to be in control. It might have another major surge lower, but for the time being, we're finding support there. So that's how we're kind of trading it. And, I talk about how we're trading it. I mean, this market's been extremely frustrating the last 7, 8 weeks or so. We did well in August and everything went down. When there's trends, it's easy to trade. In times like this, it's not so easy. It really makes you realize who the good traders are, who the disciplined traders are. And the way we're trading is very short-term time frames. We really like these new weekly options, which I'll talk about a little bit later. Very liquid. You can trade them. Also they're short-term. You're holding stuff for 2-3 days, because in this market, things look good for 2 or 3 days. You have a good gain, and bang, just like that, you've lost your gains. And that's what's definitely hit me in my trading. But trying to fight back, it's just been a difficult world. So that's what you have to adapt. And as long as we keep seeing these short and violent swings, that's probably the way you want to trade, is short and violent. Just take this quick profit and move on. Now, incorporating analyst ratings. Here are some sector plays. This is how we kind of view the world. The different world, one way we view the world. We follow about 35 or so different sectors. We compile all the tickers, and we look at the analyst ratings. Now, what this is the stocks above their 200-day moving average also. As you can see, there's utility, electric, 51 tickers. 58% of them are above the 200-day moving average, which, as you know right now, most stocks are beneath their 200-day moving average, as the market's been extremely weak. But also what's neat about this is only 39% buys. That's be quote-unquote bearish. Not too many buys. But we like this. This is bullish. A lot of stocks are holding up, yet there's some negativity from the analyst community. So again, that's what we look for. So utilities are some names. If the market gets killed, well, you're going to be wrong no matter what, probably. But if we can hold tough, there's a lot of reasons for. We think the utilities keep doing well and keep outperforming, and electric utilities is one that we definitely like. Also, restaurants and retailers, you can see them in there, held up relatively well in the face of the sell-off, yet still less than 0.5% buys according to the stocks we follow. And you talk about consumer discretionary, the XRT, that's the big retail ETF. It's actually up year to date. At least it was a little bit ago before I checked before this, and maybe it's back to negative after the sell-off we saw. But nonetheless, it's holding up much better than just about every single sector. Virtually break even for the year. Yet analysts simply haven't caught on. And when you talk about retail, consumer discretionary, restaurants, all you hear is the negativity about the U.S. consumer, the jobs market. And you can't disagree with any of that. But when that price action continues to hold up, it tells you something's at work under the surface. The expectations are just simply so very low that, again, we're not seeing signs that we're in a recession. It doesn't mean we're not going to go in one. But, when you see consumer discretionary holding up well, that's the market's way of saying, things aren't great, but, hey, there's still some positives out there. So that's what we like to see. Retail, restaurants, utilities, those are some groups that we think offer a lot of potential price appreciation at current levels. Now, the flip side is weak price action with a lot of bullish sentiment. And if you look at this, you can see sectors that we kind of, I guess you could say, would be bearish on. Oil names, really it's a lot of the commodity names, and they've obviously just been crushed lately. And we've been loading up on some of these coal names and some of the steel names, and we just think it's weak price action, yet just too much optimism in our opinion. You can see there also Wall Street, and those I think like Goldman Sachs, things like that, and the banks. Like I said, we've been extremely bearish banks for a while now. I mean, when the market was holding up well over the summer, I'd go on TV and do interviews, and you always get bullish and bearish, and we were always bearish banks because mainly you look at the big bounce in the XLF from '09. It didn't really perform nearly as well as the overall market, so it underperformed. And now that things are starting to really, break down and roll over, once again we just see extreme underperformance from banks and areas like that, and specifically also those commodity names. And those areas we want to avoid, or more specifically, look to purchase some puts on any and all bounces. And we had the 4-day, 5-day bounce recently, 2 weeks ago. and we loaded up on some puts, because these again are groups that we just don't like because the technicals are weak and too much optimism, and then you have a terrible week like last week, but it's actually good from a bear's point of view. So those groups we just still think will continue to go lower here. That does get pretty complicated here, so I'll just gently touch on it, but it's something we've been working on for a while now. It's relatively new, and this is buy to open data. I know from the ISE, you can purchase this buy to open data, and that's exactly what we do. And then if you're at all good with Excel spreadsheets, you can create these charts yourself. This is actually a chart of the XLF, the financial ETF. You can see the blue line going up is 50-day ratio, put to call ratio of the buy to open data from the ISE on the XLF. And our theory is that blue line was going higher during the financial crisis. There was more calls being bought. Now you say, well, okay, calls are being bought, so that's optimism. But we think, what it was a lot of these hedge funds, people were buying calls, obviously, by the spike higher, but they're hedging themselves, and they were going out actually shorting the shares. You could look at the short interest in any of these financials, and they just went off the charts. So to us, as long as they kept going higher, it said, the bears were in control. And then you could see a major peak and subsequent pullback, in early '09, and that was a sign. Okay, well, maybe they finally starting to take off the shorts, taking some profits. And we all know how bottoms form. A little bit of a rally, short covering rally, keeps going, and kind of manifests into itself. And this is data that you can buy this in the ISE and you can compile it yourself. But it's neat because it is buy to open data on options. That's one problem with a lot of options activity we've seen is that buy to open? Is it sell to open? It can get a little confusing, but this is nice because they tell you it's wide open, so you know exactly what's going on. These are quote-unquote bullish bets or bearish bets, and then you kind of spin it from an ETF point of view. It's hedge funds out there kind of doing something one way or another, and you also look at short interest. It can be very powerful. Now look at it right here, right now. Like I said, we don't like financials. This is getting kind of lower. Now it is still going lower. And historically, lower is not necessarily bearish. Usually when it's going higher, it's more bearish. But, we're watching this closely. We fully think that there could be another surge in this higher. And that, again, would just be another sign of proof that, the bears continue to dominate and continue to really think these financials could go much, much lower. The Volatility Scorecard, I touched on this earlier. This is something that we've been working on in-house here. What it is we're looking for stocks that are mispriced. We all are. Not rushed to say options that are mispriced. We're looking for stocks that move a lot, that the options maybe aren't priced for that much movement. It ranks various underlying securities based on a relative attractiveness to move relative to their options. Numbers 0 to 100. If it's got a number of 100, that's probably a name you want to be trading options on. Now, it's not just a bullish wall. It's not. It's not a bullish or bearish indicator like the next bullet says. No directional component. What it is, though, is it definitely it tells you things move. Like I mentioned earlier on the potash, what was it, 97, 96 component on the Volatility Scorecard that said, there's a good chance there'll be a major move coming. Who knows? It could have been higher, and I could have been dead wrong, but I'd rather trade things that are volatile and moving than things that don't move. Now, what is it? Our QA guys came up with it, but I can briefly touch on it. Historical volatility divided by intrinsic volatility. Scores, you kind of look at past versus present volatility. Implied volatility. So you kind of measure the past versus present. Gaps. How many times is a gap? We like to trade things at gap a lot. Obviously, again, that shows it's a big mover. There's a big mover score. How often does it move 3 or 4% in one day? And then the average move score is how much is the move per day. So again, it's all components. I believe these are equal 25% weightings. We're just looking for stocks that move a lot. Now, what we've seen is we've had, again, I touched on this, we've had a lot of success trading weekly options. And here are some names that the ISE actually has weekly options on. And you can see F5, Qualcomm, Las Vegas Sands, Bank of America there, which we just added more puts on, and then the RUT. These all have high names, so those are the names that we would highly, we'd be looking at and think there's some opportunity there. Also, you can look at this with ETFs also, but these are some of the names the ISE actually produces. Then on the flip side, you have Rambus, which, as we all know, usually moves big once or twice a year. But it also, you could argue, maybe makes sense to sell a lot of options on those because it does move. Yeah, it moves eventually, and that could get you when it does. But at the same time, it doesn't move enough for how expensive options are. Rambus does have the component for a lawsuit every time. So Goldman is a good one also. It just doesn't move as much as those options per price. You can sell options on something like that. Whereas the other side, volatility scorecard, when it's high, F5 last week we actually did a straddle on it. Mainly based on a weekly straddle, mainly based on what we just said here. The options are, we think, cheap. And, you don't really straddle, of course, you don't really care up or down. You just want it to move. Unfortunately, we had a big sell-off, and our straddle was, I forget exactly, but over 100% winner because of that. You can look at F5 last week, had a rough week. And again, that's a volatile name, so that's definitely a scorecard in a way that we think, if you're trading, looking at ETFs or stocks in general, you want to trade the stuff that moves. These are things we've been working on. I'm going to finish up here. Humphrey B. Neal, this is a neat quote. The crowd is most enthusiastic and optimistic when it should be cautious and prudent, and it is most fearful when it should be bold. Here's just a ISD resource. You can read that. And I've got a couple minutes here. I'll go through some of the questions that I've seen. One of the common ones is, what do you think of gold? And, clearly gold is correcting. Gold's an area, though, that we think is a little dangerous. Let's look at GLD, gold ETF. It was above 180 recently. Clearly it's not anymore. And every time it's got above 180, that's been trouble. And I'm not saying gold over a bull market's done, but there's no question that, gold it's volatile, and it's scary because during times like this, the quote-unquote the hedge funds have to raise cash because people want cash. So what they make the most money on, they make the most money on gold and silver. So that's what they're going to sell. During the financial crisis, it's something I think people kind of forget, because I've had reporters call asking why is gold going down. The simple reason is, a lot of people selling gold right now to raise cash. And the financial crisis, gold didn't go up, gold went down just like the market did. So it is the safety play, I guess you could say, but at the same time, maybe it's not as much safety play as a lot of people thought when things go bad now. Gold's up, I believe, 10 years in a row, so eventually it'll go lower, but, I'm not sure if this is the year, but it definitely is much more touch and go if the overall market really crashes, which I think that's going to happen because of what we said, a lot of negative sentiment out there, but at the same time, you have to be open to it. As traders, we don't try and, we try and predict the future, but we try and guess on it and make the most highest probability. We're not trying to make it work, hammer the square peg, I guess, with a round hole. It doesn't. You just trade what's there, and still the market looks weak, gold looks weak, so take it as it is. Also, a common one that's popular is, what do you think about the VIX? We look at the VIX. I saw it some today. VIX futures are still predicting a pretty big surge in the VIX. You look at the VIX above 30. The 30 level on the VIX is kind of, I think, a pretty good, neat bull bear gauge. 30, was resistance earlier this year. Recently, obviously, well above 30, and now we're finding support down around 30. So as long as the VIX, the fear gauge, is up above 30, there's probably a good chance that those markets will be very vulnerable to losses, or at the very least, this extremely frustrating, choppy, news-driven, rumor-driven market that we've seen. That one says I finished a short interest. A short interest simply is just how many. I guess maybe I could have explained that a little better. When someone shorts something, it's just in essence, a bearish bet. You sell it first and you buy it back later. You're trying to get lower prices to pocket the difference. In other words, it's a bearish bet. So when you see a lot of short interest, that tells us a lot of shorts, a lot of negativity on the shares. And again, our studies have said when there's high short interest, that means volatility. So we like that. And also the trend. If you have stocks going lower, like financials, with short interest continuing to surge, then hey, that's potentially bearish. That's, again, a good sign if you're bearish, I guess. So, once it peaks and starts to roll over, kind of like what we talked about with that put the call ratio or call put ratio. That's, once they've surged, okay, well, they're done pushing it lower. Now they're going to start taking profits. Now you might have a lot of people taking profits. So you want to see it keep going higher. With that, it's 5:30. I'm sorry again. We had a little delay there in the beginning, but I'm going to stop around 5:30. It's when we were supposed to stop originally. So again, my name is Ryan Detrick with Schaeffer's Investment Research. Hope everyone enjoyed it, learned something, and everyone have a great night. Thanks. Bye-bye.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.